You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli.
All right, everybody. That music means it's time once again for Options Bootcamp, the program here on the Options Insider Radio Network, where we break down all of the interesting ways that you guys can use options in your own portfolios, do a little bit of education, some strategy, some analysis, and of course, answer quite a few of your questions. I'm happy to hear that music again. We haven't heard it in a while because we've just been busy doing a bunch of other things here on the old network. Haven't had a chance to sit down and do some good boot camping, but now it's time. I got my whistle. I've got my drill instructor cap. I'm ready to go. And of course, if you guys are joining us for the first time, I know a lot of you guys are. You guys find us in iTunes or other places, and you start listening at episode 1. In fact, some of you wrote in with that similar type notion here today. Maybe we'll get to those a little bit later. But if you are listening to us, of course, the easiest place to get the full archive, maybe you have an issue getting it in your usual podcast store, of course, theoptionsinsider.com. You'll get all, I believe, 100-plus episodes out there now, so you can really dive deep into the full boot camp archive. You want to learn about cash secured puts or married puts or covered calls or collars or all that stuff, or a lot of other topics. You can dive into there in the archive and see them all right there. Pretty easy. Click on the Insider Radio Network tab. The whole overlay comes up. Pick your show, in this case, the Options Bootcamp program, and you're off to the races. Of course, you can always find iTunes, TuneIn, Stitcher, all the other places, although sometimes I know they limit how many episodes they go back. So if you want to see the full archive, get it there, or of course, grab our mobile app. It has it all there as well. That's available on iOS, Android, and the beloved, ever-entertaining, ever-fun Fire OS. All right, and joining me on the program, as usual, the yin to my yang, the dark side to my light side. He of black hat infamy, Mr. Dan Passarelli, the founder of Market Taker Mentoring. Dan, welcome back to the Options Bootcamp program, sir.
Oh, Mark, I'm glad to be back. It's a beautiful day here in Chicago, albeit a little toasty.
Yeah, a wee bit warm. Speaking of beautiful days, I hear you just came back from some beautiful days out west where you guys were doing some hiking, maybe some spelunking, some diving for pearls, and also maybe a little bit of options learning. What was the deal with that?
Yeah, we just got back from beautiful, scenic Telluride, Colorado, which is where we had our third annual options training retreat, which is a 2-day event every year, Friday and then a Saturday, where we get together with a group of our students, have some pretty intense training, and do some fun activities together. And man, we had a great time, lots of learning, and a really, really good support group type environment.
Speaking of lots of learning, let's get to it. It's been a while since we've done this, Dan. Do you remember how the show works? This is where we educate people about options. You remember how that works?
Vaguely. But I think I can pull it off.
All right, I'll see if I can hold your hand and guide you through the process as we dive right on into our Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, it's time to do a little bit of basic training here. on the old program. I'm actually going to kind of cross the streams a little bit, a bit of a Ghostbusters homage there. A combo of basic training and our mail call segment, because this actually was inspired by a listener, actually a couple of listener questions, but one in particular. I'll read it off here for you, Dan. It actually seemed like this was we've had a flurry of questions on this topic, it seems like, of late. A lot on the on the option block program, just because we haven't done a boot camp in a while. But I want to make sure we get it here on the program they're actually writing to, which was boot camp. This one comes in from Mark Davis. He says, hello. Hello, Mark. I'm a new listener to Options Bootcamp, and I'm currently on episode 4. Well, congratulations. You're clearly a man of excellent taste. He goes on to write, there was a mention of using covered calls to generate a, quote, dividend. I am having trouble tracking down more information on this. Being still new to all of this, I am hoping to get a clearer picture of how it works. How far out on expiration should I look at, and how do I figure out the strike price? Thanks, Mark. Well, good questions. I thought we had so many people with similar questions recently, Dan. I thought it was a good time to kind of go back. Like he mentioned, we talked about it on episode 4. It's been quite a while since we've really done a deep dive into covered calls, and maybe talk about some of the use cases, some of our methodology, the way we like to execute covered calls, and kind of the pros and cons therein. Let me start with his obvious question, the dividend part. I think I've mentioned this before, so maybe I'm the big offender. Maybe you've done it as well, Dan. I don't know. I've often said you can use covered calls to generate a dividend income stream. That seems to throw people off. I use dividend in kind of the fun sense of the word. There is no actual dividend being paid. So maybe we'll just knock off the dividend portion. We'll just call it an income stream, because people think of it as a dividend like it's some sort of regularly occurring and guaranteed payment from the company. That is not the case. This is something you're doing on your own. So you're creating your own income stream. Whenever I say dividend in there, even though it's effectively what you're doing, it seems to throw people off. Maybe that's one of the reasons why Mark couldn't find that particular use case for covered calls. But if you're looking for names, if you do like an income stream, you typically like a lot of high dividend yield names, then a covered call might be a good way for you to approximate that with other names that don't pay a dividend. So you can kind of create your own, what is effectively your own dividend, even though it isn't really a dividend, so don't look it up that way. All right, that said, maybe before, because I've had a chance to talk about this at length, Dan, maybe I'll let you run on this a little bit before I give my thoughts. Kind of just walk our listeners a little bit through kind of your thought process when someone comes to you for the first time, and typically in this scenario, they're a long equity trader, and they want to kind of harvest some additional yield, some income, boost their return a little bit on that position. You know, how do you approach it with them? What's the typical way you set up your covered calls? And we'll kind of get started from there, because there's a lot of places we can take this conversation.
Yeah. The word dividend, I think, can be a little tricky because it's not technically a dividend. But putting words in Mark's mouth, which I'm sure he loves that I do.
I'm used to it, sir, by now.
Yeah, exactly right. You know, like the whole concept of dividend is, hey, I own this equity and I get paid because I own this equity. So kind of the same concept. But what we're really doing here is we're, harvesting is another one of the words that I think is pretty commonly used. Generating income is, I guess, another one of the ways that we put it. I think it's a really, really fantastic strategy. It's one that I've been using a whole bunch recently. So yeah, let's dive deep and get into this sucker.
Well, a couple places we could start. I was thinking about it, because there's so many different ways to approach it. Maybe we'll start with the most traditional covered call type approach, which is, I'm sure, probably the way a person like Mark and others are looking at it. They're long equity. They want to get a little capital appreciation. They also want to get a little bit of an income boost to their position. So they turn around, they look at the strike chain, and they probably think to themselves, okay, I want to write typically an out-of-the-money call. So that's, of course, a call that has no value right now, nothing but extrinsic value. Its strike price is above where the stock is currently trading. And you do that because reason you're holding that stock is you think it's going to go up. So you want to get a little bit of that appreciation. Now the question for you becomes, where do you want that to draw that line? Where is an acceptable amount of appreciation versus the amount of income you want to bring in? Obviously, the closer to at the money or even in the money you go, the more income you're going to generate. But the flip side of that, there is no free lunch. And the flip side of that is the less capital appreciation you will actually experience and be able to participate in your portfolio. So let's say a proverbial 5% out of the money call is a good place to start. And that's a good area. I mean, again, every stock's going to be different. Your outlook's going to be different. If you think the stock's going to vacillate a little bit or maybe trend even lower a little bit, maybe you want to be more aggressive with that call. If you think it's going to explode north, it's coming up on earnings, something like that, maybe you want to be a little less aggressive or perhaps even not write the call at all. These are all situations you need to evaluate on your own. And Mark didn't give us any specific names that he's looking at, so we can't really give him any specifics. But that's a typical good starting point. A couple of things to think about when you're doing that. We've mentioned this before in our premium harvesting type episodes, which are, first off, when you're writing covered calls, you want to keep it close to the vest in the sense that you want to keep it very, very close to expiration. I think a good rule of thumb for a lot of our listeners is no farther out than a month. If you go beyond a month, you get into 2-3 months or more, you're really not maximizing the theta, the time decay portion of that option, which is what you're trying to collect when you're selling options. It's all about harvesting the most theta possible. So when you start going farther out the chain, it may look attractive. That price is going to be more than that front month or that weekly option. You say, hey, if I go out 3 months, I can get this for 2 or 3x what I'm selling this other one for. That may be technically true, but how that decay plays out over time is not going to be in your favor. And there's been numerous studies. You can look them up. There's been a few recent ones. Again, a lot of them over there at the Options Industry Council website, optionseducation.org. You can find them. We have links to them on the Options Insider as well. Of course, SIBO Options Institute has done a bunch as well recently, all comparing the efficacy of writing weekly options versus monthlies versus longer term, from a pure income generation perspective. There's other perspectives to consider as well, risk, drawdown, etc. But just from a purely income harvesting perspective, weeklies outperform every time. So it's an interesting thing to look at. So that's definitely where you want to focus your attention. Monthlies at the farthest out. And if you have the time and the wherewithal, perhaps weeklies. It's a balance. You have to look at your commissions for your broker and see kind of how that balances out. Maybe monthlies make a little bit more sense depending on how you're executing. But in general, you want to keep it in that very close window because that's where the most aggressive part of that time decay curve is going to happen in that final month or so. That's what you want to collect. So that's where you want to start. No matter where you're writing your covered calls, that's where you want to focus them. A month or perhaps less, maybe even into the weeklies, depending on where you're looking and how you're setting it up. Then again, it comes down to that strike selection. And, it depends what you're looking at. I know some people who are aggressive covered call traders, and Dan, maybe you have some thoughts on this as well, who like to write in the money covered calls. And they do that for a couple of reasons. First off, the premium is going to be higher, obviously, so they're collecting a lot more for every write. And also, when we talk about volatility skew, and if that concept confuses you listeners, I encourage you to go into our archives and look up the episodes entitled Volatility and Volatility Skew, and you can listen to those for yourself. And also, every episode of Volatility Views also breaks it down pretty well. But volatility skew, there's a little bit more volatility premium in the puts than there are in the calls, or AKA the put wing, the options below the at-the-money strike. So if you're selling options in that area in terms of below the at-the-money strike from a call perspective as well, you're getting a little bit more volatility juice in them as well. Of course, the flip side of that, you're not getting any capital appreciation. You're getting stock called away every month or week or wherever you're doing it. But still, it's an interesting way to structure. I don't know, Dan, do you ever take that approach? Do you ever go in the money or maybe even deep in the money to get aggressive with your covered calls? Or at that point, do you not think it's worth doing? Do you rather just stick to out of the money? How do you typically structure your covered calls?
My go-to way of doing covered calls is out of the money or sometimes at the money. However, I have been teaching in my classes recently, my covered call classes, on in the money calls. And it's kind of an interesting story on how that evolved. This is a few years back. By now it's several years back, I guess. But a neighbor of mine who's a really, really smart guy, one of the smartest guys I know, he was a really big trader for one of the major banks, and I run into him, and I say, oh, what are you doing these days? He says, well, I'm taking some time away from trading. I said, oh, okay, well, how are you spending your time? He says, well, teaching the kids how to play baseball and also managing some money. I go, oh, okay, that's cool, but what's your strategy? He says, well, I sell a lot of in-the-money covered calls. And I'm thinking to myself, what? This is like one of the smartest guys I know, and he is selling in-the-money covered calls. I mean, at this point, I never really ever even entertained that idea. Like, it seemed kind of crazy to me. And so he said, yeah, I've got a portfolio of, a bunch of stocks, and the ones that are the weakest ones that I'd consider selling, but I'm not dying to sell. Like if it goes lower, I don't want to sell it because the price is too cheap, but, I'm about ready. I write in-the-money covered calls on, as long as you're getting, now the key to this, by the way, the key to this is you have to get enough time value because it's very easy for novice traders to look at a in-the-money covered call and say, wow, look at this big premium. This is awesome. But it's not all awesome. The in-the-money value is just simply, the in-the-money value doesn't count. Because remember, you're going to sell the stock at a price below where the market's trading. So that represents a loss. The in-the-money value of that covered call balances that out. So the real benefit is the out-of-the-money value. So it can be a really, really fantastic strategy under the right set of circumstances for people who know what they're doing with it.
Yeah, it's a good point about the in-the-money calls in particular, because we talked before on this program about intrinsic and extrinsic value, listeners. Intrinsic being what Dan was referring to, kind of the meat on the bones, the amount of actual value in the marketplace that you're getting from that call, versus the extrinsic being kind of the fluff, the juice, the time value, the interest carry, all that kind of other stuff, the volatility premium that's built into that call. And it's important to remember when you're writing options that only that latter portion is actually going to decay. If the call is $5 in the money and is trading for $5.50, that $5, if everything else is held equal to expiration, is not going to go away. It's not going to erode. It's not going to lose that value. Because right now, if you exercise that call, buy the stock $5 below the marketplace, you can instantly turn around and sell it in the marketplace and make that $5. That never changes. That doesn't erode. So that's something to keep in mind when you're writing in the money covered calls, is that you have to have, like Dan said, a little bit of juice on there, which maybe makes the weeklies less attractive. Maybe you have to go out monthly, but you definitely want to keep that in mind when you're writing those. Don't want to go too far out, because then you're kind of having the other issue we were talking about earlier as well, where you're not maximizing the theta portion. But yeah, there are a lot of people who, Dan, I would deem to be sensible people who are looking at that approach now of in-the-money covered calls, particularly now in this kind of environment. We are recording this right now, listeners, right towards the tail end of July here, 2016, and in the marketplace right now. Volatility fairly low. So if you're out there, you're a regular premium seller, you're kind of sitting on your hands right now wondering kind of how do I get a little bit of extra juice, a little bit extra bang for my buck. And it's challenging. So one of the ways you can do that is to migrate your option writing into beyond the at the money, into the in the money strike. Just remember, it's going to clip your upside tremendously in terms of you're not going to have any. So make sure that if you don't have an outlook for aggressive upside in this name anytime in the near future, because you're not going to participate in that. If you do, then writing aggressive in the money covered calls, not the way to go. Also, the thing to mention too, for Mark and anyone else there who's considering doing covered calls, is that when we talked about this before, I encourage you, go find our episode Options Bootcamp entitled Synthetics, because that's where we talk about this in a lot more detail. But effectively, synthetically, from a risk perspective, at the end of the day, a covered call and a short put, a naked short put, so nothing against it, just selling a naked short put, are risk equivalent. They're the same thing. So when you think about that, maybe in some of these scenarios we're talking about, where you're talking about tying up a lot of capital to buy the stock and then turn around and write the call against it, so you have multiple commissions, multiple legs of a trade, etc., it may be more effective for you to instead write the put. So think about it that way as well, because that's a way to free up a lot of capital in your account. You're still generating an income stream. Also, hopefully you're using it the right way. You're choosing a strike that you're happy buying the stock at when you're writing that put. That's always a big consideration at first. And then also, if you are concerned about risk, of course, you don't have to do it naked. You can do it as a put spread instead. You're going to reduce a little bit of your income there, but that's a way to do it in a much more risk-mitigated fashion. And the naked short put can also be used as a way to leg into one of our other favorite trades on this program, which is called the wheel trade. I know our friends over there at RCM like to call it the triple income strategy, whatever you like to call it. It's effectively getting paid to get into and then get out of a stock position, which is an attractive thing. If you've ever worked a limit buy order or a limit sell order in a stock, you know how that works. And you're putting risk out in the marketplace. You should be rewarded for that. Writing a put to get into the stock and then turning around with that long position you have now in the underlying, and then using a covered call to get out of the stock. That's a way to get paid to get in and a way to get paid to get out. And hopefully you get a little bit of appreciation in the middle there as well. So that's another way you can kind of turn this on its head. Take advantage of some of those synthetics we're talking about to maybe, instead of doing all the other stuff, just write the put. If you get assigned, turn around, write the call, and you have a nice little wheel on your hands. Dan, I know we talked about it before. It's been a while since we brought it up on the show. Are you a big fan, maybe instead of the covered call, of going the short put, or perhaps short put spread route, perhaps more in your case, and then also turning it around as a nice wheel trade if you do get the stock?
Yeah, it depends on your objectives. It always depends on your objectives. I mean, I probably said this on the show before. I'll spend some time talking to students saying, "What the heck are you doing selling puts for? You're crazy. You shouldn't be selling puts. You should be selling put spreads. It's just blah 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 blah. Bad risk management." And then I spend some time talking to some students who say, "Oh yeah, so yeah, this is an ideal situation for selling a put." So it really depends on the objectives. I mean, here's kind of where I draw the line in the sand. If you're an investor, selling cash secured puts can be a fantastic thing. If you're a trader, cash secured puts are a dumb idea. You should be doing spreads instead. That has a lot to do with your time horizons and your real objectives. Like, the thing with cash secured puts is you can get assigned. And the reason I use them is so I do get assigned. I want to get assigned. Like, a lot of times people take like some, watch some YouTube video on cash secured puts or something and figure they have it mastered. And they say, "Oh yeah, well, I'm okay if I get assigned on this." And then they get assigned. They go, "What the WTF? I didn't want to get assigned on this. This is ridiculous. Oh, Jesus, what's the matter here? I didn't want to get assigned." And so, only investors should be writing cash secured puts, and you should want to get assigned, not be air quotes okay if I get assigned, because it's not about being okay. It's about, this is my target. I want to buy the stock here. If I do, I'm happy. And to that point, we talked about this a lot in Telluride in one of our classes. You're always going to be wrong whenever you're selling cash secured puts or covered calls for that matter, but that's okay. In the long run, all the premiums you take in and all the scalping you do from, what you refer to as wheel trades, I call the recycle trade, way makes up for the fact that you're basically wrong. You're basically either buying too high when you get assigned or selling too low on covered calls when you get assigned. So, it can be a great thing if it's part of a real plan, not just a way to try and steal money out of the market.
We're all about stealing money here, Mr. P. You're the black hat guy, after all. You should be all for that kind of stuff.
Yeah.
All right. I hope that answers your question there, Mark. Again, it depends really on the name you're looking at. Don't get confused by the term dividend. It's just a covered call, just an income stream. Think of it that way. Makes it a lot easier. And then you have to look at your objectives in terms of where you want to structure the strike, out of the money, at the money, or in the money, and also how far out you want to go. Remember, when you start getting beyond a month or two, you're really getting into dangerous waters just because you're not effectively maximizing that decay. I know a lot of people out there, big financial advisors and asset managers, like to just kind of set it and forget it. They write a 3 or 6 month option and they turn around and do something else against their portfolio. They put it away. They come back to it a few months later. That's not the optimal way to generate income. You have to be more on it. You have to be a little bit more of a babysitter if you want to really maximize your income stream from that. But if you're okay doing that, and you understand what we were talking about earlier, and you listen to some of our earlier episodes to kind of get a handle on it, then I think you'll be okay. All right, Spence, we got a lot of questions lining up. We haven't done this in a while, Dan. Let's spend the rest of the time answering some questions. Let's go into a mail call palooza.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Like the man said, welcome back to the mail call, the portion of the program where you guys get to take the reins with your questions, your comments, your insights, not just for us, but for your fellow Options Bootcamp listeners. Lots of different ways to hit us up here. The website, probably the easiest place to go. It's all kind of baked in there. You can use the website feedback form. I know a lot of you guys like to do that there. Or questions at theoptionsinsider.com if you like email. Social media, we're at Options on Twitter, probably the easiest place to get us. Also, The Options Insider on Facebook and Options Insider on StockTwits. So easy to find. Different names, unfortunately, on all of them. But that's kind of the way social media goes. And, of course, it's all baked into our mobile app. If you just want to go that way, download the app. And as you're listening, as you're streaming, you say, what the heck was Dan really talking about? I think that guy's crazy. Let us know. We want to hear from you. Just like our first listener here, our first writer in, Robert Kornacki. He says, I would like to use a strategy regarding naked puts. If a naked put is far out of the money, what strategy could I use to protect myself? Could I use some type of order in case it was getting close to the naked put strike price? Thanks. Well, we were just talking about naked short puts here, so this is a very timely question, Robert. And there are a few obvious ways to go to protect yourself. Like I just said in the other segment, in the earlier segment, the easiest way to protect yourself is, instead of selling a naked short put, if you are concerned, selling a put spread. That's kind of the easiest, most basic way. Turn it into a spread. That's a good way to go for options in general. If you're concerned about risk, turning it into a spread can mitigate a lot of that risk. Now, of course, the flip side of that, you're not going to generate all the income you're perhaps looking for. But if you're looking at perhaps using short puts as a way to get into a certain strike, you may not want to buy that stock anyway beyond or below a certain strike to the downside anyway. So if things turn bad and it starts dropping low, that long leg on that short put and turning into a put spread could be a very nice cushion if something terrible comes to pass and all of a sudden maybe something horrific happens and the stock is plummeting. You don't really want to buy the stock at that price anymore. That long leg and that put spread will be a savior for you. Trust me, you'll be thankful for it. So that's the easiest way to go in terms of that. The other ways to go, well, he asked here, Dan, about order types or perhaps babysitting that short put a little bit. What are some other methodologies you like to use aside from just going straight up put spread in order to mitigate your risk when you're writing puts?
I think if you're the kind of trader who likes to sell way far out of the money puts just to kind of try and grab a nickel and hope to not get a sign, probably the best way to protect yourself is to put some bars on your window, because at some point you're going to lose your ass and you're going to want to jump out your window. That's a terrible way to make money. There's so many better ways to trade that have better risk reward, better risk management, just make, statistically speaking, better sense. Just don't do that. That's what professional traders jokingly call the time bomb trade, because you're going to make a nickel, you're going to make a nickel, you're going to make a dime, you're going to make a nickel, you're going to make a dime, and then you're going to make money for 3 years straight, and you're going to think you're just a genius. And then one day there's a black swan event, and the market moves 6 standard deviations through your strike, and you don't lose a nickel, you don't lose a dime, you lose a boatload of money, and you have to mortgage your house. So the best way to protect yourself is to not do that, to trade smarter.
Good advice, sir. Best way to avoid a bad situation, not to get into it in the first place. And, of course, that's probably the easiest way. Order types. You're talking about there's some sort of baby order types. You can always, of course, have an order to buy back that put at a certain point if it goes against you too far. Those orders work very similar. A limit order very similar to how it would as a stock limit order as well. So you can certainly use that. That could help you as well if you're more confident in that than perhaps your babysitting abilities, or perhaps you don't have time to watch the position if it gets close. You can just, hey, if this put goes this much against me, I'm just going to buy it back, and that's it. That's an easy way to do that as well. Some brokers also have some kind of babysitting functionality they built into their platform, so they will help execute orders at different levels for you. So maybe you can execute or utilize that. You don't say which firm you use or what you're doing here, so we can't go that specific. But in general, the put spread or indeed just a limit order in case you're worried about it. Good ways to go. Let's see here. What about another one? Dmitry. This comes from Dmitry Shesterin. He writes, what happens to leaps on tickers that get delisted before expiration? I don't know, Dan, you've traded a lot of different products. I never had one that actually got delisted. Did you ever trade one in the middle or during a delisting process when you were down the SIBO?
Well, I was in situations once or twice where stock got taken over for cash. So, the name didn't exist anymore after the X date of the deal. And so what happens, I imagine a delisting would maybe be the same. Well, okay, let me finish my train of thought. In those situations where a deal is taken over by cash, the expiration date comes earlier. So that can be kind of a wild ride. Like you think you've got 3 months until expiration, but no, expiration is tomorrow. So that changes a whole bunch, changes the value of your options, changes your management style, changes your P&L drastically, potentially. I would think that when a stock is being delisted, they would let the leap, they would just let everything roll off and just stop adding new strikes. But I'm not really 100% sure on that one.
Yeah, I think you hit on it there where it kind of depends how the name is effectively delisted. There's a lot of ways that could go. I think the way you mentioned is probably the most common, which is effectively that some sort of corporate action, and so the name is acquired, something else like that. So the name is effectively delisted; it goes away, but you have a very clear cash equivalent or some sort of cash or stock price trade or something like that. You have a clear value that those shares are going to be worth going out. So that's where the stock settles out, and the options settle out like that is expiration effectively for all of them. And obviously they're not listing any more leaps, and anything that goes out beyond that date when the company goes away, they're settled out at that price where the company goes away. That's pretty much the most obvious way. Other ways names get delisted that don't really impact a lot of our listeners is when they kind of just lose a lot of their value. So the exchanges delist them. They get down into the sub-dollar, into the pink sheets area. In that case, if you're own calls, obviously those are effectively worthless anyway. If you're short puts, it's a different story. The stock is still trading there, so you have to look into how those work. But you mentioned leaps. Usually leaps, 9 times out of 10 people are using leap calls. They don't see many leap put sellers. If you are, you're doing it wrong. Let's see our conversation we had earlier. So that's not usually the issue, leap puts. That said, it could be. If you have a specific question about how your particular underlying is going away and how the options will be treated, you have to contact the folks over at the OCC, the Options Clearing Corporation. They're the ones who determine all this stuff, and they'll tell you exactly. I think you just call them at 888 Options. That's their options helpline. And you can ask them, hey, what's going on with this series? And they should be able to set you straight. So if you have a bizarre scenario beyond kind of the more common ones Dan and I just discussed, then contact those guys and they'll walk you through it. But those are kind of the general ways. Yeah, and they're not going to add any new leaps. Obviously, those things don't keep trading beyond the time that the name is delisted because the name is gone. There's no underlying, can't really trade options on it. So it's kind of a bit of a, it's like Dan said, it could be a bit of a alarming wake-up call if you think you got 6 months more of option to go and all of a sudden expiration is next week. That could be a bit of a wake-up call that you don't want to get. So something to keep an eye on as you're trading some of these more funky and exotic and perhaps less value names, shall we say. All right, this one comes from Fred. He writes, I read Natenberg's Options, Volatility, and Pricing twice now. So he's a determined fellow. He goes on to write, and I've also set up paper trading accounts. So he's doing a lot of good stuff here, Dan. He goes on to write, but I'm stuck going forward in my options progression. I don't want to trade using the Greeks formula. I think he's stepping on your toes there, Mr. P. He goes on to write, but I want to spec on crude futures intraday using options. What should I do? Should I make more sim trades until I figure it out, or am I just too ignorant to trade options? Well, I think we can answer the last part first. You're not too ignorant, Fred. Anyone can do this with a little bit of work, a little bit of effort. You've certainly put in the effort. Reading Natenberg twice is no mean feat. Paper trading accounts, those are all good things. You're kind of taking a lot of the good early initial steps to learn about this stuff. I don't know, Dan, maybe we'll start with the Greeks conversation. Sounds like he's not a big fan of the Greeks. That must strike you to the quick, being an author of multiple tomes on the Greeks. What do you have to say? Maybe we'll start there, then the thoughts on the rest of Fred's question.
Well, I mean, the Greeks are helpful. I mean, they explain what your risk is, I mean, I don't know why somebody wouldn't be a fan of knowing what their risk is. I mean, I use the analogy all the time. It's like the dashboard on your car. That's like saying, I'm not a fan of looking at my speedometer or gas gauge. I'm just not a fan of it. It bores me. It's too complicated. I mean, more information is better. I mean, you can have what they call, what do they call that? Analysis paralysis, right? But that's for people who, maybe aren't looking clearly at the information. More information is always better. And the Greeks distill exactly what your risk is for the silos that affect the value of your option prices. I mean, they're extremely helpful. Yeah, I don't know. I mean, I don't know why somebody would say I don't like the Greeks, I mean, and yeah, I mean, I did write the book on the Greeks, but it's not a personal affront to me. I mean, if you don't want to use it, don't use it. But I just don't understand why somebody wouldn't want to trade with more knowledge, with better information and better understanding.
I like that analogy. I like that what you're going with there with the speedometer. That is a good. it is a good use case, or good analogy for the Greeks. It's just more information. You got to know how fast you're going. You got to kind of know what your risk is. You got to kind of know what your effective delta and everything else, vega, theta, all that fun stuff is to really be an effective options trader. So it's certainly something I like that analogy. I may end up borrowing that on a future show. So I'm just letting you know now, Dan.
Well, I've actually copyrighted that, so...
well, then my check will be in the mail forthwith, sir. All future uses. I'll plan to use it at least a couple times a month, so give me like a group rate, a bulk rate, and we'll be good. All right, let's see how many more we can get to here. Let's start with... this one comes from Jack Rieger. He says, do we, I should say, me and Dan, have any specific strategies near or on expiration to profit from theta decay? All right, our friend here, he wants it all in the kitchen sink here, Dan, in terms of the most effective strategies. Well, obviously, it's kind of funny. There's kind of two parts to this question as well. There's the collecting theta decay. We talked about that earlier in the show about maximizing your theta, bringing it closer to expiration. But kind of the notion of expiration right now is kind of a fluid thing as well. It used to be this once a month kind of big deal, all the options expiring, everyone's kind of up in arms, a lot of stuff happening, a big buzz of activity, and now expiration is every Friday, and if the SIBO has their way, they've added Wednesday weeklies, they're going to add Monday weeklies on the SPX, so other exchanges will probably follow suit, and we're not that far away, Dan, from daily expirations, which kind of throws all this stuff we're talking about here into a little bit different light, because now expiration is no longer this very rare thing. It's a very frequent, some might say too frequent thing. So it kind of changes a lot about what we're talking about, what the notion of theta decay and capturing that in a daily expiration cycle thing is a totally different beast than once a month or once a week. But that said, a lot of the strategies we talked about before, of course, all of your traditional premium harvesting strategies, your short puts, your short put spreads, your covered calls, anything that has maybe short legs around the at the money to kind of maximize that sort of harvesting. So it could be an iron butterfly, could be an iron condor, all those other spreads with wings type things. You can use a lot of those things, or butterflies, whatever you like to use. All of those types of strategies. If you do have short legs, somewhere near around the at the money strike to maximize your theta exposure. That's what you're talking about. You're talking about theta decay. Theta decay is the fastest, and the at the money strike right around expiration. Of course, that's a dangerous place to be. There's all kinds of gamma kicking in. Your theta is getting near exponential. Your gamma is getting near exponential. Every tick of the underlying above and below that strike is going to cause all sorts of fluctuations to your portfolio. I don't know about you, Dan. I used to be able to walk around the floor of the SIBO on Expiration Friday, back when it was a big event, and I could just visually pick out, the crowd is looking at them, who was massively short a bunch of essentially trying to collect a bunch of theta, so short a bunch of options, and who was effectively long and is trying to close out, because one guy was sweating profusely and popping tums and looking at the clock and really feeling every tick of that clock, and the other guy was kind of just going through his day that goes a regularly normal day. So if one of those ways sounds better to you than the other, then maybe trying to maximize all of your theta decay right around expiration is not perhaps the best strategy for you. That said, Mr. P, you have any thoughts for our friend here, the well-named Jack Rieger? Sounds like a Tom Clancy novel or something character.
Yeah, I mean, I think that trading close to expiration, let me define what I think is useful to trade close to expiration. I think like on expiration day, you're going to be pretty hard pressed to find any trades that aren't just pure gambles, so getting that close to expiration, I think is too close, but I mean, weeklies offer some fantastic opportunities. I think if you're selling it could be selling or buying. I mean, let's start with the case for selling first. If you're selling a weeklies option that expires on this Friday, and it's Monday or it's Tuesday, possibly even Wednesday, you can get some really nice theta decay. I mean, it's always a balance, because sometimes you have to sell so close to the strike to get enough meat that it's not worth it. It's too risky. It is a gamble. And then buying too, you can make the case for it too. I mean, yeah, it has really big theta decay, but if you get on the right side of a good sized move, I mean, you could have an extremely leveraged profit, because the weeklies are so darn cheap, and the big gamma that they have can make them so darn valuable with the move of a couple of bucks or so. weeklies offer some really great opportunities. So trading close to expiration, I'd say if you're within 3, 4, 5 days, like that time horizon, oh yeah, man. There's some great opportunities, and I don't know. I mean, I can go on and on about very specific examples, but really for both buyers or sellers.
Indeed. Of course, if you're looking to harvest data, you maybe don't want to buy too many options around expiration. But yeah, weeklies do offer a lot of interesting stuff, and it seems like from all indications, we'll be getting a lot more weeklies to choose from very soon. So if you like weeklies, stay tuned. More are coming. All right, next up, this comes from the very creatively named Bobby. He says, or he asks, I should say, how long, there's a couple typos here, let's see if I can navigate through. How long did it take you to become comfortable trading credit spreads? Also, what is my max loss when trading a credit spread? And I don't usually do doublers, but this is a related question from the guy who just wrote in. I'll give him a bonus. I'll give him an extra question too. He has almost the exact same question. Robert Kornacki, he wants to know again, high on a debit spread is the most you could lose your credit. So people clearly have a lot of questions, Dan, about debit and credit spreads and the max losses potentially therein. Why don't you walk our listeners through how this stuff works? You buy a debit spread, you buy a credit spread. What is your max loss, and how does all that stuff break down, sir?
Yeah, I mean, as far as how it took me to get comfortable with credit spreads, I had a different path. I made my first trade on the trading floor. I started as a clerk and learned. So, everybody learns different. So if you're just getting started and you're thinking, man, how long is it going to take me to get comfortable with this? I'm dying to be able to trade credit spreads well. Or if you've been trying and struggling with it, don't worry about it. Everybody's on their own time horizon. Just keep working at it, keep learning, keep studying, and you'll be comfortable, man. You'll be comfortable in no time. Definitely do some paper trading. That's going to help you get comfortable too. Now, as far as your maximum loss goes on a credit spread, it's pretty straightforward. It's basically a simple mathematical formula. What you do is you take the difference between your two strike prices. So like maybe you sell the 65 calls, buy the 70 calls. The difference is $5. And you subtract from that your credit received. So maybe you sell the 65-70 call spread for $1. So your max loss is 5 minus 1. Your max loss is $4. Now at first glance, it seems kind of disparate. It seems like, well, what the heck? I can make $1 because your maximum profit is your premium received. I can make $1, but I can lose $4. That's a pretty lousy trade. I don't want to do this. But you have to appreciate the fact that they're high probability trades. The market has to move decidedly a lot in the wrong direction for you to get into trouble. If it's a call credit spread, if it moves down, you're fine. If it stays where it is, you're fine. If it moves up a little, you're fine. You need sort of an unlikely thing to happen in order to lose money. By unlikely, I mean, less than 50-50 odds, in a lot of cases, less than a 30% chance of running into trouble. So that's it. It's a pretty straightforward formula for credit spreads. Distance between the two strike prices minus your premium received.
Well said, sir. We got a little more time. Let's see how many more listeners we can welcome in on the program. Next one comes. We got so many lined up here, Dan. They've been waiting. They've been chomping at the bit. For us to get back. I can't tell how many people have come up to me at different events I've done or emailed us, say, hey, when are you going to do another boot camp? So they're excited that we're back, I'm sure, Dan, and people listening live. I forgot to mention, top of the show, we're streaming it live. A little bit of fun, extra surprise for you guys here. So if you missed it this time, we'll try to give you a little bit more warning next time. We kind of do boot camp on a little bit more of a indeterminate schedule until we get it back down to a regular schedule again here on the network. So we'll give you some warning. You can, if you follow us on social media, or maybe Dan or a few others, you'll see the link go out. You can listen to us live via Mixlr, Mixlr, and that, of course, you can available on all the different platforms and on your devices of choice, and you can stream it live. And if you want to ask questions live, you can do that too. You have to just have a Mixlr account to do that. But don't worry, you can always hit us up. You can always stream us live. A lot of people like to do that and then hit us up by the usual platforms, Twitter, etc., through the show and during the show, and that way you don't need a Mixlr account. If you're so inclined, you don't need to add another free account to your life. I can certainly understand that. All right, let's move on to a question here from Tor. I like that name. Tor Johnson Lugosi. Wow, that's a name. He goes on, he asks us, hello, Well, hello, Tor. I am restarting my options trading on a shoestring. Any thoughts on mini options? Thanks. Minis have been coming in a lot on the network over the last month or so as well, Dan. I was trying to figure out why that is. If we had kind of two themes to our questions over the last month, it's kind of how to structure covered calls and questions on minis. Maybe someone must have done a big webinar on minis somewhere, or maybe something got picked up. I don't know what it is, but we certainly haven't done anything on minis in a while. And there's a reason for that, is that minis are effectively dead. It's a sad state of affairs. I think myself included, I think in some of our recent conversations on this, I've labeled minis as, to me, one of the bigger surprises in terms of developments, surprise failures, I should say, really, in the options market over the past, 5 or 10 years. I think just talking to everybody in the launch and the lead up to minis, everyone was so excited. You'll recall they were conceived and created and approved by the SEC at a time when Apple was flirting with 700, and all the names everyone likes to trade from a retail perspective were all just extremely premium priced, and no one could afford to trade them, let alone trade options on them. So it seemed like minis were going to be the panacea to all the ills of the options market. And then fast forward a year or two, and they were finally launched. Actually, it was about a year. It wasn't that long. And it seems like everyone has collectively dropped the ball. The clearing firms passed along full, full fees on the clearing side. The exchanges passed along full exchange fees. Brokers tried to charge full commissions. And guess what? The market makers weren't having any of it because they were not touching these things until they were a proven commodity. So the spreads were wide, and you were paying full commissions for a 1/10 size product. Guess what? No one wanted to trade them. You have to be an idiot to kind of trade those things because you're paying a lot more on the spread and you're paying a full commission for a 1/10. People aren't stupid. And I think brokers woke up to this fact a little bit too late, I think, and they realized they were kind of gouging. I think that was kind of just everyone thought the things were going to be such a home run that they put the cart before the horse, and they really just priced them like they thought everyone was going to gobble them up, and the opposite happened. No one touched them. And then effectively, I think it was about a year ago, a little over a year ago now, we saw the first exchange say, yeah, we're not going to list any more of these minis, and what that effectively means is they're delisting them. And then as they expire, they go away, and that's kind of what happened. I don't think there are, I think we were discussing this on one of our other programs, there may be one or two minis still floating around out there, that maybe there were some Leap minis that they haven't expired yet, but I don't know, effectively these things are dead and buried, which is a shame. I don't know, Dan, we haven't really talked about minis on this program. What were your thoughts on those? Were you as surprised as I was to see them go away? And then maybe in lieu of minis, do you have any other thoughts? You were just talking about weeklies. Weeklies may be a good surrogate for our friend here, Tor, who's looking for some cheap ways to play options.
Yeah, I mean, as far as was I surprised by minis not working out? I don't know. I mean, I think when that was going on, I think maybe we did have I know I had conversations about minis, but I can't remember. Honestly, I don't even remember what I thought about them. I think I was just kind of like figuring I'd be a spectator and just see what happens. So, I'm not surprised, but I'm not like I didn't expect it either. I don't know. It's just, I think the exchanges are kind of jumping the shark a little bit with all these products. Like, options are great tools. Just stick to the fundamentals and trade options. And I think if exchanges focused on that business, just like, conventional options, they could be successful, but they keep listing all these crazy, cockamamie new options products. And, I think the market can only take so many. And I guess that's what happened with minis. Notwithstanding the marketing and operations errors that you pointed out, Mark. But I think what you just mentioned too is a great idea about if you're looking for like lower priced options to maybe trade. Weeklies, the closer you are to expiration, the less options are worth. So, maybe you can look for weeklies opportunities. Just the one thing, since you mentioned, since the caller mentioned that, he's on a shoestring budget, just, one little word of caution, make sure you never trade with money you can't afford to lose. But if you've got some earmarked for your trading accounts and, you're prepared that, hey, there's a possibility I could lose this, then good, go ahead and try and trade as conservatively as you can. Capital preservation, follow your rules, have a plan, and hopefully we'll see that account go from a shoestring account to a nice little nest egg.
Well said, sir. All right, people responding on Twitter about using the Greeks or perhaps the lack thereof. It's kind of funny. One guy saying, "If I don't want to use the Greeks, why would I listen to your show?" Well, if you don't want to use the Greeks, then I don't know if you're if you should be trading options. But we try to make it fun regardless. And maybe Dan could bring you over to the dark side of them there Greeks. He did write the book, after all. All right. I said I won't do this, but he's a good listener. He writes a lot. Let's have one more here from Fred. I think he comes in from the Top Step Land, those guys over there who listen a lot, and I beam into their chat room every week, talk about futures options. He has a lot of futures-oriented questions. He asks, is it my imagination, or do options traders trade more markets than futures traders do? Is that a good practice? Is it good to look for multiple markets when trading options? Should I expand my horizons? And he has an interesting viewpoint. I think like a lot of futures primary traders, and maybe even a lot of stock traders, they tend to be a little bit more myopic. They focus on one or two names that they like, that they follow on a regular basis, and that certainly can be an effective strategy. And trading what you know is a good thing. But I think he may be thinking, Dan, here of a lot of the professional market maker types who trade, by definition these days, they have to trade dozens, if not hundreds, of different underlyings and the options on them in order to really be profitable. But that's more of a reflection of kind of the nature of the business these days, where you can't really make the money that you used to be able to make just trading one, like an IBM or an Intel or whatever the case was back on the day when on the trading floor days. You could trade one or two names and make a good living at it. Nowadays, that's not the case. You have to trade dozens, if not hundreds, and really have a lot more risk spread out across a bunch more names in order to really try to make up that in volume what you lack in any one individual name. So professional traders certainly do that a lot. And maybe also a lot of active retail. I think they tend to be, in general, options traders are typically the more active of the financial clientele, however you want to measure it. They tend to trade the most, and then they do tend to trade a lot of products. So there may be something to what you're talking about here versus maybe some stock or futures guys who tend to focus on a handful of things. I don't know, Dan, is that your takeaway as well? Or do you think maybe Fred's mistaken? And what do you think about that notion? Do you think he sounds like he's maybe a little bit new to options, so maybe he should probably focus on what he knows, might be easier road for him. But your thoughts in general on his ideas that options traders trade more, in general, more underlyings?
Yeah, I mean, part of it is because, well, I mean, I'm just kind of thinking of this off the top of my head, but I mean, I think part of it is because there are more names out there in the equities market than there are in the futures market, I mean, the futures market, there is kind of a shocking number of futures contracts out there, like when you consider all the expiration months and such. There's a lot more than you think. But I mean, it's still, it's corn and it's beans and it's bonds and it's, minis and all that. But there's thousands of different stocks to trade. So you just have more choices. And it's kind of like, if there's more stuff you can trade, you're going to trade more. So, yeah, I mean, I think it's just because there is more that you can trade more. Well, and also, I mean, I guess the liquidity is fragmented a little bit more too, I mean, there's definitely more people who trade securities options, definitely more volume in securities options, but futures options have their fair share of volume as well. And so if you trade one of the more common futures options contracts, there's tons of trading going on. So there's tons of different opportunities, arguably liquidity, although because those are single lists, their markets are a lot wider than they should be, frankly. And so in securities options, because there's thousands and thousands of different things that the same pool of people is trading, there's a little bit less trading going on in a typical name. So arguably less opportunities, less liquidity. I don't know. It's just kind of a theory off the top of my head. I guess I never really thought of it too much before.
That's the fun of this show. We like to put Dan in fun situations and make him think off the top of his head. But that's why we like you guys writing in, because you keep us on your toes with your different interesting inquiries. Unfortunately, that's all the time we have for the mail call segments. Also all the time we have for this episode of Ye Old Options Bootcamp. Don't worry, Dan and I will be back sooner than you can maybe handle. So don't worry about that. We'll be back. So all you guys bugging us out there, hey, when are we going to get some more boot camp? I need some more boot camp. In the meantime, of course, there's a lot of great archive episodes for you guys to really sink your teeth into. And if you do have an options question, maybe it's a very specific one, maybe it's a very esoteric one like some of the ones we had today, or maybe it's very general and basic. Whatever it is, hit us up. We love to hear from you guys. The app's the easiest way to do that, or the website, or, of course, at Options, or questions at the Options Insider, or all of the above. however you like to hit us up. Carrier pigeon will also work if you want to send it here to the studios in Chicago. And if it's a good one, we'll get you on the old program. But before we go, Mr. P, a.k.a. the black-hatted one, we just talked about your big summer sojourn with all of your students out there in Colorado. Thank you for my first-class ticket on, and, of course, all expenses paid vacation to Telluride. That was very nice of you. I wasn't really expecting that. But now that that is all done and behind you, what can our listeners look forward to coming down the pike over there in the land of market taker mentoring?
Well, we're actually doing a webinar on futures. By the time you guys hear this this broadcast, it will. Well, I guess the people who are listening live, I guess you could attend our futures class. We're having a class on futures, free class tomorrow, Wednesday at 3:30 Central Time, and we might be doing a little bit more with futures going forward. I have tons of people ask me on a regular basis, "Hey, do you teach classes on futures?" And I say, "Well, no. I mean, I've traded them before, but we don't have classes on them." So now we're going to do that. We've got a really great guy with a great deal of experience as a market maker trading futures down on the trading floor here in Chicago, who's going to be teaching the class. So sign up. I guess you can email me, dan@markettaker.com. If you'd like a link to that webinar, I'd be happy to send it off to you.
If they're listening live, can they also just go to your website and maybe register there at markettakermentoring.com or markettaker.com?
You can. Go to markettaker.com. I had my marketing guy set it all up, so I don't know the exact URL to send you to. But if you can't find it, you can just click the Contact Us page on our website, and we'll hook you up. We'll make sure you get in.
And, of course, if a lot of you guys listening after the fact, of course, via iTunes and the website and everywhere else. And, of course, you can always head over to Dan's site for all those archives and all the other fun stuff. And if you can, join us live. We'd love to see you here. It's always fun to get some of that live feedback, live questions, live comments. We'll try to get Bootcamp on a more regular schedule for you guys, so it's a little easier for you guys to plan your calendar around it. So don't worry. And on behalf of Dan and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming. We love to hear from you guys, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.